Jason Goldberg to discuss. Barclay's managing director, senior equity analyst. Jason, great to see you. Thanks so much for joining us. I guess the first question for this quarter for the sector as a whole is will there be reserve builds or releases?
Yeah, we certainly don't think there will be reserve builds. You know, the top 20 banks added $65 billion to their loan loss reserves in the first half of 2020. And you've really yet to see loan losses emerge, in part because of all the fiscal stimulus we've seen both early last year as well as the tail end of the year. And, you know, I think there is a potential for releases, just given the economic data has, I think, been better than most banks expected. You've got additional stimulus as well. On the flip side, though, you know, you're cognizant of the fact that COVID-19 cases continue to rise. And, you know, there are additional kind of business restrictions and kind of shelters in places in various markets throughout the country. You know, but net, we do think the bias for reserves is for releases rather than builds.
So what will you be looking for? We're expecting, I guess, a bit of a messy quarter, but a lot of focus on the outlook and what these banks are planning for in terms of recovery. What should we watch?
Yeah, no, certainly in the fourth quarter in particular, the outlook is always in focus. And you know, given the big reserve builds we saw in the first half of last year, you know, earnings, you know, for the median bank in 2020 are going to be down like 30%. So it's sharp decline. However, you know, I think looking out over the next 2 years, you know, we think the industry can grow earnings in excess of 50%. So a nice rebound. And we think that'll be a function primarily of lower loan loss provisions, as well as the resumption of share buyback in the first quarter. And we think that could accelerate as the year goes on. And also, as the vaccines take hold, we think loan growth will pick up. In addition, you know, while capital markets revenues were quite robust in 2020, both investment banking fees and trading, you know, we think a lot of the momentum can carry into 2021. And while maybe down year on year, you know, could be another good year of results.
So, Jason, the sector's had a great run over the last 3 months or so. A lot of the banks are above where they were pre-pandemic now. Is there much room left in terms of upside in the short term? And do you think buybacks are as good a call as they sounded like 2 months ago, given that share prices have appreciated so much?
Yeah, so, you know, we do think, you know, this recent kind of bank stock relative rally could have some legs. And, you know, despite the surges on the back part of last year, you know, it was still the second worst relative performance year for bank stocks in our 84-year data set. And while the runs continued into this year, you know, relative valuations are still below historical averages. So if you have this rebound in earnings we talked about earlier, and we think you could build a case for multiple expansion as kind of capital redeployment picks up, and as banks kind of shift from reserve build to reserve releases, and we do see further upside, you know, over the intermediate term. Obviously, trading them day to day around earnings can sometimes be dicey. You know, to protect the share buyback, you know, if you kind of look at the Fed's kind of current construct, you know, the banks could buy back 0.5% to 1% of their shares, you know, on average in the first quarter. But as the year goes on, we think those restrictions get eased somewhat further, and you could see that pace of buyback accelerate. And, you know, most banks buying back, you know, 5% to 10% of their shares in totality for this year.
Jason, thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.